Welcome. You're listening to the Best of Investing on News Talk 910. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. For those of you listening for the first time, here is our format. A few guys sitting around a bar having drinks or without the drinks, talking business with you, the audience, listening in. And I'm your host, Edward Brown. I'm honored to have as my co-host Mark Hanf of Pacific Private Money, California's premier private lender, and Brian Burke of Praxis Capital. Our phone number is 888-912-1190, and write that number down, 888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. The vacations are sponsored by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco, and the vacations are free. Their only request, a $75 cleaning fee to cover housekeeping expenses. Their website is lighthouse4fun.com. You can reach them at 916-777-5511. And today's trivia theme is unusual sports stories. I knew you guys would like that.
Yeah.
Okay, our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. And don't forget, World Wraps in Corte Madera and Santa Clara is still giving our listeners a free smoothie with purchase of a wrapper bowl. If you mention the Best of Investing, go there for lunch today. They actually have a brand new wrap called the Polynesian Pulled Pork. And don't forget to mention the Best of Investing for your free smoothie. All right, here we go. Ordinarily, we have an extra guest in the studio, but today I'm going to be the guest. And so I'll interview myself as well as you guys. And what we're going to be talking about is the ins and outs of life insurance, because I've been licensed since 1984, and I've been quite an expert on life insurance for many years. And I want to share with the audience certain secrets to make sure that our listeners are not overpaying for their life insurance. All right?
And we're going to make this exciting.
And we're going to try to make it exciting. Okay. So go ahead, guys. Shoot me with the first question.
Well, the obvious question, Edward, term versus whole life or universal life, what's the deal with those?
Okay. Basically, term insurance is for the term of whatever you decide you want to buy your life insurance for. So it could be you want to just buy a 5-year policy, could be a 10-year policy, or it could be what they call annual renewable term, which is every single year you get a new bill and it keeps going up in price, all right? It's got no value at all. Versus if you get something like whole life or universal life, you give the insurance company extra money, but your premium basically would stay the same and it could build up some value. And we'll get into that a little bit more when we get into other questions.
So when you said with the term insurance, if you're older, would the term premium be higher than for younger people?
Of course, because the odds of you dying are a little bit easier then, right? Except if you buy the policy when you're young enough, then you can get it fixed. So there are policies out there that you can buy a 20-year term policy, and if you're, let's say, 30, it's guaranteed not to go up for the next 20 years.
I'm on my 19th year of a 20-year
You are.
policy.
Okay,
so
we're going to have to talk
Getting
about
close.
that.
I shudder at what the premiums are going to be on
It's
renewal.
gonna skyrocket.
Oh.
Yeah, I'm just telling you now, because now you're
Telling the audience how old I am.
That's right. Sorry about that, but no, that is the truth.
Skyrocket, thanks.
And that's what happens a lot of times is that, and I'm not advocating one type of insurance versus another. I'm just trying to educate the public here. Generally speaking, if you have the money, you can do a better deal with the universal or whole life policies. But it's kind of tough because the premiums are very expensive. So what ends up happening is instead of paying, $200 a year, you might have to pay $2,000 or $3,000 a year. But it'll stay constant and it'll build up some cash value.
Which has a lot of value for the policyholder if they're going to need that insurance throughout their whole life. But for someone who might just need to bridge a gap for, the next, if something were to happen to me in the next 5 years, we're really going to need this money. But after 5 years, I think we'll be okay. We won't need any insurance. That might be where the term would be a better deal.
Generally, yes, but I'll tell you in reality what happens is, you have little kids, and so you say, okay, well, I only need this term policy for, let's say, 15 years. Kid's 5 years old, when the kid's 20 years old, we don't need insurance anymore. But things change, and you start looking at your estate, and you start looking at, gosh, you know what, my wife really kind of needs this extra income to replace me if I'm not there. So definitely term insurance does have a place. And in fact, for me personally, I'll tell you what I did. I bought a universal policy and I stuck $10,000 a year into that policy in my 20s. And I only did it for about 6 or 7 years. And I built up a lot of cash value. And basically the plan was I never had to buy insurance for the rest of my life.
Now, I know that was really popular in the 80s and 90s, because I know that we had bought a form of a universal life when they first came out, and they were promising some pretty high returns. But
Yeah.
are those still worthwhile investments today? What kind of internal rates of return are you talking about
And that's
that
an
are available
excellent question.
in this era of super low interest rates?
Okay, so let's go back in time for just a minute. In the old days, you know, 1910s, 1920s and all that, pretty much all they sold was the whole life type of policies.
Mhm.
Then the insurance industry went through a change, and people realized, wait a minute, let's come up with a product where if it's just dirt cheap insurance and people could invest the difference, they'd be better off. And that worked for a number of years. Then in the late 1970s and early 80s, the insurance industry woke up and they said, you know what, we're losing a lot of business because people are just buying this deep, dirt cheap term insurance, and we really want them to buy this little bit more permanent policy, because otherwise people just keep jumping around from insurance company to insurance
Right.
company, right? So they came up with this thing called, you know, universal life, which meant that, again, people would give the insurance company more money, and you're right, back then they were paying as high as 12% interest, and it was tax deferred. But
Wow.
nowadays with interest rates low, the interest rates have dropped substantially. Now, policies I sold people back in the early 1980s that had a guaranteed minimum of 5.5%. So they were earning 12 for a long time, and then it dropped to 11, 10, 9, 8, 7, 6, and now they're still earning 5.5%,
5.5, right.
which is
That
pretty
sounds
good
great in
today's
this market.
Yeah.
It does. But again, you know, I'm not trying to push people to buy one versus another, because what ends up happening is that there's a lot of costs that come out of those policies.
Up
And
front.
That's right, and so you really do have to look at the difference between, gosh, should I just buy term insurance and invest the difference? And I'll make it really simple for everyone here. The IRS has something called, or it's Congress basically, but it's called a modified endowment contract. What that means is the IRS basically says, you know what, you can throw all of this money into into insurance and build up as much cash value as you want, tax deferred. However, wait a minute, this is too good a deal, right? Because think about it, let's say you had a $100,000 policy, and let's say you could invest $90,000 in it and earn 3 or 4 or 5% tax-free. Right? That's a pretty good deal. Plus, you still have this insurance, right? Because you can buy the kind of insurance where they add the cash value to the 100,000.
So you get
might get
190, yeah.
exactly. Or there's different ways to do it. You can do it where you just get 100. Well, the IRS said, wait a minute, that's too good a deal. So they actually limit it and say, based on your age and how much you're going to be putting in and for how long a period, if you put in too much money and it builds up it'll build up tax deferred. And if you take money out, then you'd have to start paying taxes and possibly a penalty if you're under 59.5. So what the object in that case for people who have the money, have a long-term need, and can, they can afford it, is to potentially buy those universal policies and just figure out what's the maximum the IRS will allow me to put in, and go ahead and go that route. But again, they're very expensive. So what I've done is I've gotten a lot of clients into just the dirt cheap term policy, because nowadays people have a hard time coming up with money for their food, let alone their life insurance.
Right. Are these universal lives with I know that a lot of people were buying them for like annuity purposes, where
Correct.
you would invest in a universal life and you would put a certain amount of money into it with the idea that after 20 years, you'd be able to collect a monthly annuity. Is that still a popular product today?
It is, yeah. If you've got the money, you could kind of kill 2 birds with 1 stone, right? Because what you would do is throw, let's say, $10,000 a year in for 20 years, build up enough cash value to where you could start drawing an annuity tax-free. And oh, by the way, if you die, your beneficiary would get the death benefit, might be $1 million. So you kind of get the best of both worlds. So what one would do in that analysis is am I better off to just buy a dirt cheap term insurance policy for, $300 a year for 20 years and invest, $9,700 in some other
In
investment?
the annuities, right?
In annuity
Yeah.
or something else, exactly. And when we come back from break, I've got a few more little secret tidbits to share with the listeners. So we're going to cut to our first commercial break here. And here is the question. And again, we're talking about trivia theme is unusual sports stories. All right, here we go. In the 2002 World Series, what San Francisco Giant picked up Dusty Baker's son who wandered near home plate? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. In the 2002 World Series, what San Francisco Giant picked up Dusty Baker's son who wandered near home plate? 888-912-1190. Make sure to include your name, address, email address, and phone number, and please spell it out and speak slowly for us. And we will be right back.
I remember when that happened, but I'm not 100% sure, other than the obvious answer, Barry Bonds.
Bonds was in the outfield.
Yeah, don't say it. Don't say it.
Oh.
It was in the outfield.
That's-
Funny guy. Okay, so.
It was Willie Mays. No.
Willie Mays. Come on, Brian, you know this.
Joe Montana.
Joe. Do that, I like that. So funny. I love those guys. Okay, don't forget.
Oh, God, here we go. What we got this time?
What we got this time?
How
Can you
does-
see it?
You will never have a bad hair day.
Thank you.
You're welcome. You're okay.
You got it?
Got it. Thank you.
Oh, he got a note?
Oh, you were here last time. I had a note that said, "Hi, Kramer." Oops.
Oh, that is too funny.
Figured it's good for TV.
Remember, I'm the one that makes you look pretty.
That is true. Today is the.
How hard of a job is that?
Thank you.
I had a guy, an insurance agent, that used to come around our office in the '80s, and I was pretty much doing. I think we ended up firing him in the '90s, but he'd come around every couple of years and convert us into another type of policy, which back then I learned was called the churn and burn, and so we'd establish this little bit of cash value, and then all of a sudden it would be rolled into another program. Now, to his credit, I think he truly believed, because he was a great sales agent, and he was being told by his manager that, well, we got this new super product. First it's whole life, and it's universal whole life, and it's super duper universal whole life, and each time it was a little bit different, and all of these were annuity-based products where, this is so that you put in, X number a month for, X number of years, and you get an annuity at the end, and that was the challenge, is that, each time that cash value went from, 10,000 down to like 1,500, because
Well, in some cases, the insurance companies do come up with new products, but in a lot of cases, and it's kind of sad, is that a lot of it has to do with the commission.
Yeah.
And that's one of the things I wanted to get into, because there are companies that pay it's like if you sell product A, you get one commission. If you sell product B, which is effectively the exact same thing, you get a higher commission.
Oh, really?
But what happens? It gets taken out of the client. Client never knows it though.
Oh, right.
So that's why the kind of policies I sell people, you just go for the best for the client.
Yeah.
Because then I never have anybody come up behind backdoor me and go, oh man, I sold you that, I can get you something. In fact, I even had a very well-known insurance company who we unnamed. Their agent actually bought insurance from me. Because
Really?
I could sell them cheaper insurance.
Then he
could
can even get, and he works there. That's crazy.
What question do you want to ask on a lead-in, or?
We're on a dual camera setup here, Kramer?
Yeah, he's doing it.
Oh, wow. We're
Comb the
really-
back of your hair.
We're really
Or is there
getting
something you
somewhere,
want to
aren't
get
we
into
here?
specifically?
Wait till we get two more, and we're gonna have 4 camera shoot.
No, really?
As long as you go right into, you know,
Hope
the
so.
bigger the life
Wow, that'd be
insurance
cool.
company.
Yeah.
And I can kind of swing into some of this stuff here, because I kind of jump around, but that's okay, you know.
Yeah. Okay. Are we ready almost,
Yep.
or are you still, oh, so skipping over the, hello.
I don't know, I'll use one of Edward's favorite lines. It's all Greek to me.
It's all great, exactly. Okay,
It's
you guys
all
ready?
Greek to me. Yes.
All right, here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hunt and Brian Burke. And when we cut to the first commercial break, we asked this trivia question, and the theme is unusual sports stories. In the 2002 World Series, what San Francisco Giant picked up Dusty Baker's son who wandered near home plate? Brian, you're shaking your head. What's the answer?
I have no idea. My guess was Joe Montana,
Joe
'cause I don't know
Montana.
anything about sports.
That is incorrect.
All right.
Mark, what's the answer?
I don't know. It wasn't Barry Bonds, was it?
It wasn't Barry Bonds. It was J.T. Snow.
Oh.
Oh, yeah, remember? Okay.
See, why didn't you think of that?
Okay, and we are in the studio with me. Because
Yes.
I'm the life insurance
With
expert.
Edward Brown.
Yes, there you go. We're gonna try to educate the public, as they say. So, Mark, you're gonna ask me a question.
Sure.
Insurance company.
Bigger insurance companies versus smaller insurance companies, does it really matter which one I go with?
Generally, it does, and I'll tell you, this is gonna be kind of cool. All right, ready for this? Generally speaking, this is just a general rule. The bigger the insurance company, the worse they are. And the reason
At
is
what?
At giving the best price.
Oh.
Okay, and here's the reason. When you're a huge insurance company, you don't generally have to be competitive, because everyone's scared. They think, oh my gosh, you know, I can't go with
You're a market
ABC
leader.
company. I've never heard of ABC company.
That was my question is, you know, will the smaller ones not be able to pay?
Okay,
So-
and get this, and again, this is kind of cool. Audience, listen in very carefully here. Except for the cases of like fraud, where you get, you know, some insurance company called Dewey, Cheatham and Howe or something like that, right?
That's a law firm, I think.
Yeah, that's true, no, that's true. First of all, there's, I don't know, maybe 2,000 insurance companies out there.
Really?
And there's a myriad of insurance companies you've never heard of, and they're perfectly fine. They've been around for 20, 50, 150 years, okay? So get this. There has never been a situation where a life insurance policyholder beneficiary did not get paid.
Really?
Now,
Never?
Never. And now, again, I'm forgetting fraud for just a minute, okay? Because if someone wants to fraud you, that's one thing. But we're talking about insurance companies that have been around. And here's what happens, is that if an insurance company gets into trouble, another insurance company comes in and buys out the business. So potentially stockholders, bondholders, and annuity holders can potentially get hurt, because an annuity is an investment.
Right.
But a life insurance policy is totally different. So if you are, if somebody, some agent shows you a company you've never heard of, don't be scared. Okay, but you really do have to compare the prices. That's really what it comes down to, is the prices. And I wanted to get into this also with the bigger insurance company, and you were saying at break how you kept getting churn from one company to another,
Mhm.
potentially because of, you know, oh, we got the greatest, biggest, newest
Right, here's
one
a
out there.
new policy that pays out even better, but we have to convert your old policy to a new one, which just ate up the little bit of cash value that I had created over the
Okay.
previous year.
Potentially, there could have been some legitimate reasons, but in a lot of cases, and this may or may not be the agent knowing this, that there are, even within the same company, there may be policies A, B, C, and D, but A pays the biggest commission. And so, a lot of times the agents are concentrating on the commission, and what ends up happening is it just comes out of your pocket. So, like personally, and this is a little plug for me, okay, I'll be honest, I'm doing that for me, is when I look at the insurance companies that I deal with, I don't know, 100 different companies out there, right? And I will just get the dirt cheapest life insurance premium for my clients, and I'll make sure that they're at least rated, you know, A minus, let's say. I never even ask them what the commission is. And whatever it is, it is. I just want to get the client the best, cheapest, dirt cheap life insurance premium with a company that's at least going to be around to pay them, right? And I never get backdoored by another agent. And in fact, I'll get you one really funny story here. A large insurance company that will be unnamed, actually, their agent had bought a life insurance policy from me because I could sell them a cheaper policy than they could buy from their own company.
Really?
Which gets to the part about captive agents versus independent agents.
Right.
Because there are some insurance companies where you're considered a quote captive agent.
Right, you're
which-
representing one company.
That's right,
Yeah.
exactly. You never want to deal with that kind of insurance agent. You always want to deal with someone who's completely independent, because you got to figure, if there's 2,000 insurance companies out there, what are the odds that that one company they represent is going
Yeah,
to be
that's gonna be the best one.
the best?
Yeah.
And then the problem from an agent standpoint is, the more business they do with that company, the more held on to they are by them, because if they leave, all those commissions that they could potentially earn when they retire are gone. So you definitely want to deal with someone who's completely independent. And in fact, that's one of the things that I was going to offer to people here, is that if they wanted to find out, with their own insurance policy, how they're doing, or if they wanted to just get a free quote from me, you can actually leave your name and number on our 888 number, which is 888-912-1190. And yes, it is the same one as the trivia contest, because I'm the one who gets the phone call.
Maybe they can win the contest and get a better
That's
life
right.
insurance
Oh, yeah.
policy.
So it
all in the
sounds like
same
you're,
call.
sounds like you're offering a free insurance audit for our listeners.
That's basically that's what it is. Yeah, it's obviously no cost or obligation. They just give a call and just say life insurance, and then leave their phone number. I'll call them back, and we'll just talk about it. And they'll say, okay, how old are you? And here's the other thing, is that there's not a one-stop shop insurance company. I mean, I've had situations where I've had clients who had health issues. Maybe they had a heart attack 3 years ago. Well, that totally wipes out a whole myriad of insurance companies, because they don't want to deal with that. Other ones are experts with regard to cancer. Other ones are smoker versus non-smoker. So what I wind up doing is, because I deal with a company, an independent company that just totally runs all the numbers and all the insurance companies, and I give the information to them. It's really simple. I just say, okay, Mrs. Jones is 62 years old, and she's looking for, let's give her a quote for a 5, 10, 15, and 20-year term policy, because she doesn't want to buy one of those universal ones. And she's been a smoker for 20 years. So they'll run the numbers and go, okay, well, these companies are way out there, forget that, and these other ones would be better.
That's interesting. So if you're doing an evaluation like that, is there a difference between term policies? Is one term policy any different than the other than the amount of years that you have a level premium?
No, that's the other beauty of this thing. Either you're dead or you're not dead, right? Because term policies is really simple. It's money that you spend for insurance. It's not complicated.
Yeah, it seems so simple.
It really is, and again, that's why I really like this part of the business, because again, either you're dead or you're not dead, and it really comes down to price. Again, because what I said, except for a fraudulent situation, which really is hard, you don't really get too many fraudulent insurance companies out there, right?
Yeah.
And it's easy to check out to see how long they've been in business. As long as they exist, then you just go with the dirt cheapest one. And the only thing that gets a little bit squirrely is, again, what if you're a smoker? Or what if you are a cancer survivor? Then, the one company that gave you the cheapest quote, if you're in perfect health, might not give you give you the best quote for if you have health issues. So that's why, again, if people were to just call our 888-912-1190 number, and you can do that when you answer the trivia question too, it's fine. We'll just run the numbers for them.
So what kind of, do they still send a doctor to your house? What kind of qualifications do you have to do?
Exactly.
Or
Okay.
examination?
Oh, yeah. Oh, I'm glad you brought that up. You almost never want to go with a company where they say, oh, no exam necessary.
Yeah, I see that a lot.
Yeah, and the reason that what happens is you get thrown into a big pool with people who are unhealthy.
Mm.
So the only people who should do that are people who are uninsurable effectively. They're going to die in 6 months, and it's like, no exam necessary. Okay, sign me up.
So typically that's going to be a higher premium policy.
Absolutely, yeah. Now there are contestable periods like within 2 years. So if you said, gee, I don't have cancer, and then you buy a policy and 6 months later you die of cancer, they're not going to pay.
Well, I know that when I got my term policy a few years ago, they sent somebody out to the house, they drew my blood,
Yeah,
they
absolutely.
did blood
That's right.
pressure, they checked medical records and all that. And
Yeah.
then after the exam was complete and they got the results back, that's when they gave me my premium quote.
Correct.
Because they
That's right.
rated me in a better category than they initially rated me just by filling out the questionnaire.
Absolutely. In fact,
Oh, really?
the problem I had was my dad died at age 53 of a
Right.
heart attack.
Yeah, mine
I mean,
too.
Right, and
Yeah.
then that's one of the reasons you got rated is because the hereditary type thing. Now,
Yeah.
in my case, my dad smoked, didn't get any exercise, and bad diet and all that stuff, but I unfortunately don't get the benefit of going, hey, look at me, I'm healthy and, you know, I have better habits. So, again, it goes back to, you know, each company is gonna value you differently, and you absolutely want to go with one who, yes, it's a hassle to have them draw your blood, but they don't take out pints of blood. I mean, they take
Right.
out, it's so innocuous, it's just.
And they do it at your house, it's not inconvenient.
It's very convenient,
Yeah.
at, you know, home or office, whatever you want, and you fill out the questionnaire, honestly. You know, you tell them, you know, ever had any broken bones? Okay, yeah, I broke my thumb, you know, when I was 17. They're not gonna rate
Oh,
you on
no,
that.
broken thumb.
But
So-
if you lie on it though, if you lie on an application, they can go after you, so it's really best to just put all your cards out on the table.
Or not pay, if you die, could they go back and say, hey, you know, you didn't tell us that you had chest pains,
And
you
that,
know?
well, that's happened where someone had said he was a non-smoker,
Oh.
and it turned out that he was a smoker. And so the widow went to the insurance company, they said, well, we're not gonna pay. And the widow said, well, why don't I just pay the difference between what the smoker rate and the non-smoker rate, because then that would be effectively telling
Right.
the truth. And they said, no. And,
Right.
and they went to court, and she lost. So it's better to just pay the correct amount, because,
Otherwise, it's a waste.
it's a, yeah, exactly.
Yeah.
Yeah.
Is there a rule of thumb still on how much insurance one should carry?
That's a good question. The insurance company won't let you over-insure, and also you have to have an insurable
Really?
interest. Well, yeah, I mean, think about it, you know, you make, you know,
I can't just, I can't
20,000
just
a
buy
year,
a
you wanna-
$20 million
you want a
policy.
$10 million policy.
No,
Oh.
can't do that. While you're wearing a suicide bomber
Yeah.
jacket,
Right.
No, there are limits to
Or
that.
attending lots of Raider games.
Yeah, generally speaking,
Right.
as a general rule of thumb, 10 times the amount of your income is fairly safe. But a lot of it's gonna be premium driven,
Yeah.
right? I mean, if you just can't afford the premium, then you don't do it. I mean, but it's amazing how cheap this stuff really is, though. I mean, it's dirt cheap term insurance, and you want to get one. I would say that you really should get one for a good 10 to 15 years, because if you get one for 5 years, even though it's cheaper, it's amazing how fast it comes up. And then when you're 5 years older, suddenly you're a lot more surprised at how much the insurance is.
Especially the older you get, you know, time goes by faster the older you get, I noticed.
Yeah. All right, we are going to cut to our second commercial break. And again, anybody wanting a free evaluation of their life insurance, I'd be glad to give them a call after the show. 888-912-1190, and I'll give you the quotes for new policies if you want. No problem at all. All right, so here is our second trivia question, and again, what's the topic? Unusual sports stories.
Unusual
Okay.
sports.
You guys will like this one.
The question is, Brian won't know.
No, you might know this one. Okay.
Oh, okay.
In 1994, Tonya Harding was accused of hiring a hitman to take out the knee of her rival skater. Who was this rival skater? It's almost like Daytona 500.
Yeah,
right?
yeah, almost.
Okay, it's almost like
Yeah,
NASCAR.
yeah.
The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. In 1994, Tonya Harding was accused of hiring a hitman to take out the knee of her rival skater. Who was this rival skater? Call 888-912-1190. Make sure to include your name, address, email address, and phone number, and please speak slowly and spell it all out for us, and we will be right back.
I know that one.
I do too. I
Oh,
actually
you
do
do?
know one.
Oh,
I
okay.
don't
I
know
was
how
hiding
long
my
it's been since
answer.
I've actually. Yeah, you have to hide your answer because that might copy off. But I think I actually know this one.
Kramer,
which is
you know the
unusual.
answer?
No, but what was the name of the hitman?
Oh,
I can see
Guido.
him. Guido.
He was a big
He was
guy,
a
wasn't
big
he?
I
guy.
think he was a big guy, yeah.
But I see the gal in my mind. No, I don't know who she was.
Have you seen Tonya Harding lately? She's
Is
scary
she
looking.
boxing?
She does like MMA or something like that, or boxing, or I
Didn't
don't
she
know.
kind of get creamed?
Yeah, she did. She
Yeah.
just got.
That was sort
really-
of like, do you remember?
It's almost like not showing up. She was physically in the ring, but she could hardly throw a punch.
Yeah. Do you remember, who's it? Jose Canseco went
Oh,
into the
yeah.
boxing ring, and he went in with Vi Sikahema, who was a punt returner. And I'm thinking, okay, Jose's gonna kind of do all right here. He got knocked out. By a punt returner. Of course, Vaisika Hema, I don't know what he looks like, but when he's playing for the Philadelphia Eagles, I never
Just like
saw
the
what he
name.
looked like. And then now you look at him, he's buffed. Punt returner, buffed. You know?
Some of those football
Vaisika.
players, yeah, you don't want to get in the ring with them, man. They have those Adonis chisel-like bodies from all that weightlifting.
Larry Allen. Do you know how much you could bench press? 750 pounds.
Are you kidding me?
Amazing. My brother's only that
It's almost a Volkswagen.
Definitely a Prius. I can bench a Prius. That's not all they're good for.
Without batteries.
No, that's true, yeah.
Well, I told you about the Prius with that, my tire guy told me, he goes, we love Priuses because one of the reasons they get such good gas mileage is the tires are thin. You keep going through tires a lot.
Okay.
Oh, interesting.
So, what's better for the environment?
Expense.
Lots of
Yeah.
tires out
Yeah,
there.
tires in a pile that
Burning
eventually
tires,
catch on
yeah.
fire. Yeah.
Oh, I heard a funny story. This guy told me about burning tires. This guy decided, I'm going to he bought this piece of land, and it was lots and lots of acres in Modoc County.
Modoc.
Modoc, which
Oh,
is
yeah.
somewhere down south, right? So he was charging people like $1 or 50 cents a tire to dump your tires, and then it was like, okay, $1 and then $1.50, right? And he got 6 million tires. 6 million tires on the thing, right?
Oh.
And the problem is, if you think about it, you take the rim out, right? And you got this hollow thing, right?
Yeah.
Well, it rains, and it stops raining, and what happens? Stagnant water.
Yeah, then
all
you
these
build
mosquitoes
mosquito
and all.
farm.
And
Oh,
apparently there was
no.
so much environmental damage because of this. It was going to cost them $6 million to clean it up.
Oh.
So what he did was he started lighting it on fire, and it burned for 3 years. Hear those tires?
Are you kidding me?
Tires keep burning.
Yeah,
Oh.
it's hard
Isn't
to
that
put that
wild?
out. It's hard to put
That
that
is
out,
wild.
yeah.
And then he committed suicide.
Oh my gosh,
And they
they
came
didn't-
after
they
him.
didn't-
Oh, a happy
See,
ending on top of
Yeah.
it.
All he would have done would have been charged $3 a tire. He would have had enough money to pay off the 6 million,
exactly.
and he would have had 6 million more left.
There you
Or
go.
just keep moving the tires around so you don't get all the, and you can't bury them, right? Because tires.
That brings a whole new meaning to rotate the tires.
Oh.
All
It's so
right.
funny. Okay. All right, you guys ready?
I'm ready.
We're doing well. Okay, so next segment.
I can talk about latest real estate news.
Okay, because we'll go into the email time in the fourth segment.
Yeah.
Okay.
Okay.
So I'm just curious though, if you buy a $5 million term policy, is it 5 times as expensive as a $1 million term policy, or is it logarithmic?
Well, it's not logarithmic, but you do get a break. Yeah.
Interesting.
And also, you have to have an insurable interest. There was a time when these guys were going to homeless people and going,
Oh,
here,
right.
sign up
Right.
for this, right?
That wasn't long ago. They
That
were
wasn't
doing that in
long ago.
LA a couple of years ago, and there was these
years ago.
older ladies. They were getting life insurance policies on these homeless people, and then running them over with cars. This was just a couple of years ago in LA County.
That's why you have to,
Oh,
like a
my
business,
gosh.
you know, like if we're in business together, that's an insurable interest.
Right, right.
Okay, you guys ready?
Yeah.
Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with my co-host Mark Hanf of Pacific Private Money and Brian Burke of Praxis Capital. When we cut to the second commercial break, we asked this trivia question, and again, the theme is unusual sports stories. In 1994, Tanya Harding was accused of hiring a hitman to take out the knee of her rival skater. Who was this rival skater? Now, this time it's not Joe Montana, but you do know the answer.
Well, I think it's Nancy Kerrigan.
It is Nancy Kerrigan. That
And
is
I didn't even
correct.
copy off of Mark's paper this time.
I
was
I
hiding my
usually have
answer.
to look over there.
Well, I
when he
told you,
writes it
it's
down.
pretty close to NASCAR, right?
I don't know, is it? Oh, because they go in circles, right?
They go in circles, that's right, okay. Mark, you had gone to an interesting conference. Tell us what's going on in some real estate.
Well, first let's talk about what's happening lately in real estate. You know, anecdotally, you know, since I'm in the lending business and I'm lending to real estate investors who are buying, fixing, and flipping, going back to the fourth quarter, there were an awful lot of long faces in the industry because sales were really down. The fourth quarter of 2011, in my opinion, may end up being, you know, the absolute trough in the real estate industry. And what I'm seeing is an awful lot of optimism in the market. In fact, I've been talking to a lot of real estate agents who are telling me that they've got an awful lot of more properties in contract right now than they had a month ago or several months ago or last year at this time.
But
So,
are they gonna close now?
well, yeah, that's it. So the statistics for new contracts are up, and then this report just came out yesterday. In fact, it says Bay Area home sales rose last month being January, to the highest level for January in 5 years. Now, the downside of that, if you want to look at this as a downside, we can talk a little bit more about that, is it goes on to say that the median price paid for a home fell year over year for the 16th consecutive month as distressed sales rose to the highest level. So distressed sales are basically REO and short sales, and they've been making up about 50% of market sales. So,
And
Well,
usually
that's
those are the
pretty-
lower price tier too.
right. So
That's
the
amazing though, 50%?
But 50%, yes. So, but that whole concept of median price, I think, is one of the least understood concepts in real estate, because it doesn't necessarily mean that the value of your home or any investment property that you own went down. It just means that the mid-level, that there were just as many homes sold above that so-called median
Well,
price as below that.
What was the mean and what was the mode? I'm bringing up my statistics.
Mean, median, mode, right, and average and all of
So
those.
this means that half the houses sold for below that price and half sold for above. So if people are buying in that lower price
Right,
tier,
concentrated
then
in the
it's
lower
falling.
price range.
Yeah.
Yeah. So
It is misleading.
Right, it is. So, but that's the good news, and so we've got an increase in the level of activity. We've got increases in contracts. Now, of course, I know that last year at this time there was a pretty fair amount of bullishness. But the difference between this year and last year is last year most of the articles were predicting price declines
Right.
anywhere from 5 to 10%, depending on what market you were in. This year, I'm not seeing that. So I think that there's a lot of, and again, this is anecdotal support. This is just my observations based on the level of lending activity and the conversations I'm having in the industry. But there seems to be support for possibly having hit bottom. And does that mean appreciation is around the corner? No, not necessarily. But I think if the public doesn't believe that prices are going to go down further, they're going to start buying again. They're going to.
I wonder how, last month the stock market had been doing a lot of rallying. Do you think a lot of that has to do with confidence?
I don't think too much. It seems to me like, we're in the market every day as both buyer and seller, as we're buying, fixing, and flipping houses in this area. And, what I've noticed is that, as Mark indicated last year at this time, the newspaper articles were all predicting these price declines. And what we were seeing is, in actuality, those price declines had already begun, and we're about 3/4 of the way through when they first started talking about it. And,
Yep.
and it actually happened.
Typical.
So we actually got that 15 to 20% price reduction in the markets that we were in between the time of the tax credits expired in the middle of 2010 and the middle of 2011.
Well, wait, what about all the shadow inventory, the banks holding on to a lot of foreclosed properties they own now, the REOs? Are they gonna just start now, if prices start going up, start feeding them into the market?
They are, and there's another reason that they're gonna do that, and we'll talk about that in a minute, as a result of a recent settlement between the state attorney general and the mortgage servicers. But I think the point is that the market did fall, like the newspaper articles were saying they were going to do. It had already happened. Of
Did it
course,
fall
they're
because they
day late,
said it was
dollar
going to
short.
fall, or did it fall because did the news make the market? It's
Yeah,
really
it makes you wonder.
self-fulfilling
Yeah, it
prophecy.
makes you wonder.
self-fulfilling prophecy.
Well,
right?
there was
Talking down the market.
there was some false demand created by the tax credit, right?
Yes.
That pushed some demand forward, and
Like the clunkers.
Yeah,
Maybe
well-
they should do cash for clunker houses.
Well, there's a thought. Maybe.
Well, they've come up with every other harebrained idea for,
Yeah,
for
they've
trying
tried
to
to
solve
Actually,
it.
well, GM though reported record profits.
They did, yeah. That's right. That just came out. Yeah.
So tell us about that, Brian, the
Yeah.
the government programs.
You know, in October of 2010, lenders got caught red-handed in doing what it's widely now known as the robo-signing scandal. But really, what it was in judicial foreclosure states. Lenders were required to sign an affidavit with the court saying that they had personal knowledge of the facts of this foreclosure. And they were signing these without reading them and without any personal knowledge, and they got busted. Well, after that happened, the attorneys general of all 50 states gathered together and launched an inquiry into what was going on. And the lenders decided that they didn't want the risk of foreclosing on loans that they were conducting improperly, so they started to back off the foreclosures over the last year to year and a half, and we've seen a dramatic decline in foreclosure activity during that period of time. Well, just recently, the attorneys general negotiated with these lenders a $35 billion settlement, and they're going to be utilizing most of that money for what they're saying is principal reductions, but what I believe that's going to actually translate to is a more approval of short sales and calling the difference between what they approved as a short sale price and what they were owed, and calling that a principal reduction and applying that towards that balance. So I
It's
don't
like a
think
bank bailout then?
well, it's intended to be a homeowner bailout, really, but I don't think it's going to bail anybody out. I think it's just another government program that sounds really good and doesn't translate to a lot of real-world results. But now that this investigation isn't hanging over the heads of these lenders, they're going to feel more confident that they've spent the last year perfecting their practices and getting their paperwork in order, and they can now start getting back to the business of foreclosing. And that's going to bring the foreclosure level up. It's not so much the pricing, it's the fact that lenders are kind of in the clear now.
And guys, we're going to cut to our third and final trivia question, commercial break. When we come back, we're going to get into email time. We've got a couple of really interesting emails, so audience, make sure you stay tuned with us. Okay, you ready? Unusual sports stories is our theme. Which St. Louis Cardinal missed the 1985 World Series due to a freak injury when the automatic tarp ran over his leg? I don't know if you remember that. The first three callers with the correct answer won a free 3-day, 2-night stay at the Lighthouse Resort. Their website again is lighthouse4fun.com. Check out them today because the weather's getting excellent. You're going to want
It
to
is
check
nice,
them out.
yeah, absolutely.
Call 888-912-1190. That's 888-912-1190 to answer this question. Which St. Louis Cardinal missed the 1985 World Series due to a freak injury when the automatic tarp ran over his leg? Again, 888-912-1190. Make sure to include your name, address, email address, phone number, and remember to speak slowly and spell it all out for us. And we will be right back.
All right. You know, there was an interesting article in the Chronicle, I don't know if it was yesterday or the day before, that somebody had randomly selected, like, it was like nearly 600 loan documents, and I don't know if this was just in the city of San Francisco or the Bay Area, I'm forgetting now where they got these loan documents on homes that had been foreclosed, and 80% of them contained errors.
Yeah,
They
that was in
considered
Los
significant
Angeles.
errors. Was it in LA? Okay.
Yeah,
okay.
it was in Los Angeles.
Probably by the same ladies who were running over the homeless people.
Probably, yeah. I just read that this morning, actually, that just
Yeah,
came out.
I thought that was interesting. So now,
Yeah.
but the settlement now, of course, that's part of the settlement, is protecting them against, you know, that.
From getting prosecuted.
Yeah,
from
from
that.
getting prosecuted.
Well, actually, you know what the way I interpreted that story was that the errors were not necessarily in the foreclosure process, but were primarily centered around the transfer of ownership of the
Right,
loan.
right, the assignment.
Yeah, the assignment of
documents.
deed of trust. So they're
Especially when they've been assigned multiple
Yeah.
times, the trails.
And you know,
yeah.
you see that a lot, actually. It's interesting. You'll see a deed of trust come out from, you know, bank ABC, and then you
Yeah.
see the foreclosure, and it's deeded to bank XYZ, and you wonder, well, how did it get from this bank to that bank? You never did see a
Right, because you're still making the
document.
payment to the same loan servicing company on
Right.
your mortgage, and you don't know how many times they may have transferred, quote, ownership.
True.
Yeah.
I'm gonna charge you for my
Better get
gym,
you a little
my
ladder.
gym work.
Your ballet, yeah.
Or you can charge me for the workout.
Okay.
You ready?
Oh, I'm gonna change
Okay.
tapes,
Oh,
sorry.
let me,
I'm gonna change tapes.
okay. Okay, so that is.
I came up with 8 minutes, 19 seconds, but I don't have, I probably
What
have
do
the
we have
same.
left?
Yeah, well, yeah, but I don't know, what times, you had versus what I had.
You said 8:19?
That's what I had,
I think
but.
you're very, very close.
Yeah, I had 11:18 for segment 1, 13:32, and then 8:51. Well,
Yeah.
your times might have been a few seconds off from mine.
Yeah, because I could do that. Okay, so, let's see here.
I can put your numbers in if you want.
Wait, how much did
I
you
know-
say?
I know how to do that now. 8 minutes, 19 seconds.
Because we're working with 42 minutes?
Yeah, we're going 42 minutes, yeah. What times do you let me,
Yeah, you know, let's do it 8:15, just on the safe side.
8:15?
Actually, no, I'll work with your 8:19.
what times do you have?
Yeah, 8:19 is fine.
Okay.
I'm rolling.
You rolling? Okay.
All right.
Rolling.
Bingo, bingo,
It's
bingo.
it.
Okay, here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Brian Burke of Praxis Capital and Mark Hanf of Pacific Private Money. When we cut to the third and final commercial break, we ask this trivia question. Again, unusual sports stories. Which St. Louis Cardinal missed the 1985 World Series due to a freak injury when the automatic tarp ran over his leg? Anyone?
Mm-mm, no idea.
None.
Vince Coleman.
Still don't know.
Remember the Coleman stove? No, it has nothing to do with that. Okay. And let's see, email time, here we go. All right, Mark, we received an email for you, and it says here, with the government rules, are you restricted to lend only to people who have the income to pay the loan back?
Ah, good question. Well, my company, Pacific Private Money, also known as Pacific Private Money Loans, we make privately funded loans to real estate investors buying real estate or refinancing out of real estate all over the Bay Area. We typically, our business model is typically geared toward the real estate investor, not so much the homeowner. And the reason for that is because of, well, thanks to the slew of new regulations that have been passed as a result of the mortgage meltdown, the subprime meltdown, Congress saw fit to pass a bunch of laws intended to protect consumers who may be taken advantage of by those for those evil predatory lenders. And unfortunately for companies like mine, small companies that are out there making loans that the banks aren't making, we got included in most of those regulations. So we are generally not able to make a loan to a consumer for a home loan purchase or a home loan refi that they live in. And the reason is because we do now need to determine the affordability. The borrower has to demonstrate a capacity to make those payments. And here's the problem with that. Let's say you, like many thousands of people, have come on hard times. You've missed payments on your home. Maybe your home is soon to go into foreclosure, but unlike many people, you actually have a lot of equity in your home. So you'd like to come to a company like mine and say, hey, can I borrow $100,000 so I can cure my default? And I'm going to sell the property anyway, so I'm going to put it on the market and get a good price for it, but I don't want to have to sell it under duress. Well, 5 years ago, I could have made that loan, and I would have made that loan. But today, I can't, because if you're out of work and you're not making your payments, you can't show me and demonstrate the ability to make the payments.
And selling the house doesn't.
It doesn't,
qualify.
right, it doesn't matter. So the law of unintended consequences, which is what the government is so often guilty of, is they've actually now taken consumer choice away. You are now too stupid to borrow money, according to the
You
government.
hear that, Brian? We're too stupid.
Yeah. Yes.
I'm telling you, well, the government does believe that, I think.
So now let's flip over to the other side. If you're borrowing for investment purposes, you do not have to demonstrate a capacity to pay. Now, I like it better when a borrower has
Yeah.
good income. It makes for a better loan application, but there are an awful lot of people who are making a living in this market buying, fixing, and flipping.
So as long as it's not their personal residence, then you can do it.
Yeah, that's the answer.
Let me get to Brian. here.
Absolutely.
Okay, Brian, we received an email here for you. Generally, how long would my invested funds be tied up if I invest with Praxis Capital? Now, what does that mean? I mean, you have to explain what investing with Praxis Capital means.
Yeah, I suppose so. My company is Praxis Capital, and we're a real estate private equity firm. Our investment focus is in the distressed real estate sector, and we purchase foreclosed property, and it's on behalf of the investors that invest in our real estate funds.
How's
So-
business been lately?
Yeah, a little bit busy. Yeah, it's about 100 times busier than it was 5 years ago. So certainly we have a lot to do. So these are equity investments typically, and that means that they are a little bit longer term than what you might do if you're investing with Mark in private money notes, which could be a shorter term. But we range currently from some products that are a 6-month term with an 8% guaranteed rate, all the way up to a 5 to 7 year period of time without guaranteed rates, but probably higher rates of return.
How do you guarantee the rate?
On the guaranteed rates, those are just simple in and out investments where we're in and out of a property so quickly that we're able to just guarantee that they can get a certain return, and we back that ourselves. Versus in most of the equity investments, you're participating in the profits from that particular investment.
So it's guaranteed, not preferred.
Yeah, in that particular product, in our 6-month product,
I
it is.
like that.
But primarily, most of what we're doing is a preferred return and longer hold time. So we have some that are 1 year, and we have some where your money would be tied up for 4 to 5 years. And we just had one, and that doesn't really mean anything because we just did one deal. It was a foreclosed 54-unit apartment building, and we purchased it. It was a 5-year hold, so that meant that our investors' funds would be tied up for 5 years. But what ended up happening was we fast forward about 13 months, and after fixing up the property and taking it from 58% occupancy to 98% occupancy and raising the rents about 20%, the property's worth so much more than it was 13 months ago when we bought it that we've calculated out that we can get our investors about a 75% return if we sell now versus getting a 25% return annually if we wait 5 years. So even though they signed up for a 5-year investment,
They're probably not
they're
gonna
not going to
too
complain
loud.
that we got out early.
Wow.
That's amazing.
All right, guys, here's some thoughts for the day. Thanks again, guys.
Sure.
Okay, 5 Jell-O flavors that flopped: celery, coffee, cola, apple, and chocolate. Now, how can anything chocolate not be a hit? I don't understand that
Chocolate
one.
Jello, though, I don't know.
But celery,
Sure.
I understand that.
Yeah.
Celery jelly. Celery jelly.
Yeah, so you can't even say it, let
I
alone
can't
eat
even
it.
say it. And then, when I went to church, instead of putting money in the basket, I threw it up in the air. I figured God would keep what he wanted, and whatever came down was mine.
Oh,
You like
did
that?
everybody else do the same thing?
No, of
That's
course
too
not.
bad.
My idea only. And again, I just want to remind listeners, go ahead and if you want a free life insurance quote, I'll give you a call back after the show. Call 888-912-1190. We'll just give you an independent evaluation of your life insurance policy and see if you're paying the cheapest that you should be.
I think Mark and I are going to be calling you too.
Very, very good.
Absolutely.
Then we'll tell everyone how well we did. All right, tune in next week to the Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.